Hello, everyone. My name is Alex Lakatos. I'm your moderator today. I'm a partner with Mayor Brown. I'm in the Washington, D.C. office. My practice is complex international litigation on behalf of financial services companies. I also counsel financial institutions on banking and securities regulatory, enforcement, legislative, and strategic issues. By way of background, way back in 2019, we had two symposiums on artificial intelligence and financial services. One of these is in Washington, D.C. The other was in San Francisco. The turnout for both events was tremendous. And the feedback we got was fantastic. We plan to one day resume those in-person events. And for those of you who missed them, I strongly commend them to you. We're very excited once we're able to get those back live. That said, we live in the world we live in, and so we've rebooted our artificial intelligence and financial service symposia as a virtual series. So today, I'm very glad you've joined us for our very first virtual panel. It's titled Regulator Roundtable on AI and Financial Services. And I have with me a really tremendous panel that I couldn't be more excited about and more proud to introduce. Joining me today are Edward Blatnick, Beth Knickerbocker, and Andrew Ullman. And let me say a word about each of these panelists because I think they all are really spectacular. Edward is the acting director of the Office of Innovation at the Consumer Financial Protection Bureau. So we're talking about the very exciting, very bleeding edge office of innovation that they have at a very active and interesting regulator. Ed previously served as the deputy counsel at the Office of Innovation before stepping up to lead that office. And before that, from 2012 to 2018, he served as senior counsel in the Office of Law and Policy in the legal division at the CFPB. So he's an old hand there, really knows the ins and outs. Let me turn now, if I may, to Beth Knickerbocker. Beth is the Chief Innovation Officer at the Office of the Comptroller of the Currency. So once again, we are talking about a very leading innovation officer at a very exciting regulatory agency that is very up to speed on these issues. She is responsible for managing the day-to-day operations of the Office of Innovation, and she's responsible for implementing the OCC's innovation framework. She served in an acting capacity in this role from October 2016 before she officially took the reins starting in May 2017. Before that, she served as the, the OCC's legal staff. That was since 2014. And she worked in a variety of legislative and regulatory matters. She worked with groups relating to cybersecurity, financial technology, financial innovation, really all the things that I think we're excited to think about these days. And last, but by no means least, a gentleman who I am extremely proud to announce that he is a fairly recent addition to Mayor Brown and a partner that we could not be more excited to have with us in our Washington, D.C. office, a member of our public policy, regulatory, and political law practice. Prior to joining Mayor Brown, Andrew served as the Deputy Assistant to the President for Economic Policy and the Deputy Director of the U.S. National Economic Council, NEC, where he oversaw the development and coordination of all domestic economic policies, including for financial services, technology, telecom, energy, and infrastructure. So has a really interesting and very broad bird's eye perspective on these issues. So with that, let's get started, and I'll make this first one as a round robin, and maybe we'll start with Ed this time. And let's just start with this. What have you been working on recently in artificial intelligence? Is there anything you're excited to share with this group?
Thanks, Alex. Just getting off mute there. Yes, I would just say in general that this topic, and I thank you very much for the invitation to speak on this panel, is really one of the most important things on the Bureau's agenda, because and the Office of Innovation, I should say, because it both has great potential to help consumers gain access to other consumer financial products and services, which is one of our mandates, but also raises potential concerns under ECOA and other and Reg B regarding discrimination. So we're very keen on monitoring and developments in this area. One of the most recent things that we have done is that we put out a blog post back in July, and that was focused on providing adverse action notices using AI ML models. And just say a word or two about what that blog post says. One thing it says is that to remind everyone that there's actually a lot of flexibility in the current regulations and commentary about providing adverse action notices. For example, a creditor doesn't need not describe how or why a disclosed factor adversely affected an application. And for credit scoring systems, a creditor need not explain how the factor relates to credit worthiness. So I think it's important to start from from the current framework that there's a lot of flexibility. At the same time, we recognize that the commentary, the examples in the commentary are relatively dating back to the 80s. And so their uncertainty remains. And so we basically encouraged anyone using these kinds of models for credit underwriting to keep in mind our 3 innovation policies that the Office of Innovation finalized last September, the no action letter policy, the trial disclosure program policy, and the compliance assistance sandbox policy. And I think in particular, when it comes to adverse action notices, we think that would be a new kind of way of providing adverse action notices in the context of AI ML would be a good potential candidate for an application under the trial disclosure policy. Second thing I'll point out is that we announced in July that this October, in fact, next week, we are holding our first tech sprint ever, and it may be the first virtual tech sprint of all time, I'm not sure, but it's all focused on adverse action notices. We're looking for the participants, and we have quite a stellar roster of participants at this point from industry, academia, consumer groups, and so forth. We're looking for innovative electronic methods for informing consumers about adverse credit actions. So that's like a week-long event culminating next Friday, October 9th, with a demo day in which the various teams will present what they've come up with, and a distinguished panel of judges will be giving out awards to the top demos. And the director of the Bureau is speaking at the event, as well as the head of the Innovation Office at the FCA, Nick Cook. And maybe we'll just stop there because I know we don't have all the time in the world, and let my fellow panelists answer the question as well.
Edward, that's tremendous. Really, I mean, in terms of what you're excited about, so much to be excited about there. Like drinking from a fire hose, a lot going on. Let me turn it over to Beth. And Beth, what do you see in AI these days, and what is new and exciting from the OCC point of view?
Great. Well, thank you. I would echo what Ed was saying, is that there's AI and machine learning have a tremendous opportunity to really change a whole variety of areas within financial services. I've spent a lot of time, and rightfully so, on credit underwriting. I'll focus a little bit on some of the things that we're seeing in other areas. So there's a lot of opportunity with AI to enable banks to be more efficient and effective, particularly in the fraud space. And we're seeing a lot of developments around AML, BSA, suspicious transaction reporting, negative news monitoring, as well as digital identity areas. In addition to that, I think there's a lot of opportunity, and what we're particularly excited about, and the acting controller has spoken about this in a number of cases, is the opportunity to increase financial inclusion in the traditional banking space. There are a lot of opportunities through artificial intelligence to look at individuals from a credit underwriting perspective in different ways than have happened in the past, and be able to increase financial inclusion. So there's a lot of things that can happen there. I would say that one of the focus, well, I guess we have two focus right now with respect to AI. First is an inward focus and making sure that we're training our examiners, that they understand both the opportunities and the risk associated with artificial intelligence. And they're able to have appropriate conversations with their banks about this. We have seen in a lot of cases, not just AI, that it's really important for examiners on the ground to have a thorough understanding of the innovations so they can have appropriate conversations with the banks. Sometimes when you see something you've never seen before, it's easy to say no. And that's not the message that we're trying to send to our examiners. We're trying to send the message that to say that's interesting. Let's understand it and understand the risk associated with it and how you're managing that. So there's a lot of effort internally on that side. I'm also very excited about what's happening externally with the agencies together. So all of the banking agencies together with the CFPB are looking at this also from an interagency perspective and having conversations with the industry about how we should approach this as best we can in a consistent manner. We do have different mandates, and that does have results in us looking at things differently, and rightfully so. But if there are areas where we can coordinate effectively, this is an area where I think it's very important for us to do so, and there are efforts underway to do that.
Beth, thank you so much. I think a lot of our audience is going to be absolutely delighted to hear the focus on the training and the getting people comfortable with the technology so that they can understand and ask good questions and say yes if yes makes sense. I think that's just tremendous. I personally, just speaking for myself, am really pleased to hear about the emphasis on financial inclusion. Every day I open the newspaper and I just see that so many Americans are facing rocky roads these days, and it's incredibly comforting and good to know that that's something front and center for you guys, because I think we need it now more than ever. Let me shift gears now. Andrew, maybe pulling back from the National Economic Council perspective and the administration's economic policy perspective, and give us a view of what exciting is going on there and what we're seeing that we should think about.
Thanks for having me today, Alex. What I want to do is just give a quick overview of what the administration has done, because I think for those in the financial services industry, it's easy to focus on the regulators and what they're doing on AI, and that is a lot. And they've certainly moved in helping provide some clarity and signaled clarity around certain regulations, as we just heard. And there's a lot coming in the pipeline. But it's really important to understand that the work that's happening in the financial services area and regulatory area is also is just one part of what's going on in the federal government on AI. And many of these other areas actually can impact on how institutions think about AI and also the resources that are available. The administration actually kicked off a large initiative on artificial intelligence back in February of 2019. When the president signed an executive order on maintaining American leadership in artificial intelligence. The EO was designed to set forth the administration's principles for its AI policy, as well as set out some key objectives. You know, those key objectives include promoting more sustained R&D, enhancing access to high-quality data and models that the federal government possesses, and to share that data with the private sector and academia, to reduce regulatory barriers and to avoid regulations that impede AI, also to ensure that technological standards minimize the vulnerabilities that AI may have to attacks, and then also to train the U.S. workforce and to make sure that the U.S.'s advantage right now in AI is sustained and protected against strategic and foreign adversaries. From that EO, agencies across the government have been taking actions to implement it. In particular, we've seen an increase in R&D resources in areas where the federal government is now going to be making large sums of money available for our R&D related to AI. We just saw $1 billion investment in the establishment of several new institutes that will be dedicated to the study of AI and other new tech industries of the future. You've also seen OMB move forward on providing regulatory guidance for all agencies on how to handle AI in their regulatory process. And on the international scene, you've seen the administration work with the OECD and the G20 to issue statements and principles about how the member nations are going to move forward on AI policy. So there's a lot going on in the space right now.
That's fantastic, Andrew. Thank you so much for giving us a broader perspective on that and giving us the administration many initiatives in just a short, nice capsule for us to think about. I'd like to now turn, if I can, and some of this we touched on a little bit with the introduction, but to do a little bit of a deeper dive on AI in the current environment. And here are some of the things that I personally have been seeing, and they may be things you want to comment on, maybe not, but I think we've been seeing some increase of fraud in the work from home environment in a variety of ways. Sometimes people, because of the devices they're working for at home, are more vulnerable. Sometimes because the economic downturn is simply what it is, fraud is encouraged. So we're seeing some of that. We're obviously seeing simply, the effects of some economic slowdown. In this environment where you do have more people from working from home, maybe you have an uptick in fraud, maybe you have some other issues that I haven't thought about. How do we see AI fitting in? Are we seeing new and unique use cases? Are we seeing changes in what's being done? Are we seeing new concerns with how AI gets used? Any thoughts about that? Beth, maybe let me start with you if I can.
Sure. I will focus on just a couple of things. I think with the advent of the pandemic, we saw, to your point, Alex, a rapid movement to work at home. And also with that, there was a high increase in the number of questions that banks were receiving from customers around different forbearance programs and just a whole variety of things. So a number of financial institutions moved to the use of chatbots, which is a form of AI, in order to do that and to manage the calls more effectively. We also saw a lot of movement from call center activity, which is typically in a physical room, to now those employees moving to work at home environment and the utilization of AI technology there. In addition, with respect to AI models that were already in place, like for fraud monitoring, I always like to point out that the financial industry has been using forms of artificial intelligence for quite some time, particularly in credit card monitoring. And what we saw, though, was a spike in ineffectiveness of some of those models because the patterns of customers in terms of purchasing and when they purchase, those types of things moved very quickly. You went from an environment where it was easy to sort of understand when folks were engaged in online purchasing activity to everybody moving to online purchasing activity. And sometimes the models had struggled, at least early on, to take that into account and determine what the normalcy of those patterns would be. On the other side, what we did see, though, is for the models were focused on more kind of a longer term pattern, like an investment pattern. They struggled a bit in the beginning with volatility that occurred very early in the pandemic, but those models were really designed to take that into account. And those models seem to, at least at this time, work more effectively, or I shouldn't say work more effectively, but we're able to understand the patterns and correct for them a little quicker than some of the other patterns that we were seeing with some of the fraud models.
So it sounds like you are seeing some encouraging robustness in some of those models.
Yes, definitely. There's more work to do, particularly as artificial intelligence and machine learning becomes sort of a used technology throughout the entire industry to get to understand the long-term impacts of that. But as I think this is a good opportunity for those models to be tested and to understand what their strengths are and what their weaknesses are.
Got you. Ed, let's turn to you. Anything you're seeing, you're thinking about our current environment and where AI is fitting in, and where we're seeing wins, losses, strengths, threats, opportunities.
Yeah. Let me mention a couple of things, and the first thing may jump ahead to some other topics that we may cover later. But I think one thing that we are focusing on with the advent of the pandemic, there's really been a huge spike in consumer complaints on our consumer complaint database. And fortunately, we have been developing over the past number of years a pretty sophisticated complaint analysis tool using AI and machine learning. And so that, I think, is, I think it's a good example of how, having put in the work to do that in prior years, we're now able to use it to really track these complaints that have been coming in, for understandable reasons, given all the disruption. The other thing that we've just to go back to what I was saying earlier somewhat, we've been focusing on in terms of AI ML is the use of AI ML and alternative data in credit underwriting. And so, for example, back in 2017, we issued a no action letter to a company called Upstart that is basically a marketplace lender, and it uses a very sophisticated AI ML model and uses alternative data of various types. I think they probably use something like nearly 1,000 different variables in their model. And so we did that because we thought that through the use of that model, there's potential for expanding access to credit for those with no or thin credit files. And last August, we put out a blog post on the results of and Upstart has been providing us with testing results ever since then on a quarterly and annual basis. And so last August, we put out a blog post describing some of those results, which were very positive in terms of increasing access to credit for those type of consumers and not increasing discrimination risk to any extent. So that was a good news story, I believe. But then, I think the question for a lot of marketplace lending in general, all of these new lenders, how are they going to weather a financial crisis? And so obviously the pandemic has given us an opportunity to check that. And so we're currently in the process of looking at Upstart's results. We have a great window into the effect of the pandemic on whether sort of the question of whether through using AI ML in credit underwriting somehow will help consumers even during this time of economic downturn relative to lenders that do not use that. So those are a couple of things that come to mind.
I think that a lot of things you said there are exciting. One of the ones that I thought was extremely interesting is the idea of your work in AI and using that to mine and leverage learning from consumer complaints. I'm curious, is there a way for industry to also get in on the action, either to see, there's a spike of consumer complaints that the CFTC is seeing, and therefore we want to be out in front of it, or, and this may be less interesting to your mission, but perhaps to say, gee, everyone else is complaining about this problem. We've actually spent the time and resources to fix it. We could advertise that we're good on this area.
Yeah, great question. I should actually know more about this than I do, and your question is going to lead me to find out more about it. But I do have a general sense that we've made a great effort to make the complaint database accessible to anyone outside the Bureau, academics, industry, and made it very user-friendly with various kinds of APIs. And so my general sense is that, yes, the general public, including industry, has a great deal of access to that data set.
Yeah, and then that's consistent with my understanding as well. Andrew, is this something you'd like to comment about? Or I also have a slightly different question that I think is something that you're uniquely well positioned to answer, but I don't want to jump to it before I give you Okay. So this is switching gears a bit. But, it really struck me that we have, and this is something I just wanted to hear for myself, an interesting opportunity with you because of, again, what I've described as the bird's eye view, Andrew, that you offer to address, when a company is going from R&D, and you talked a lot about the administration's fostering of R&D, to a commercialized product, and it wants to sort of do that in a way that makes sure it goes smoothly from a legal and regulatory perspective. And here, it's always tricky because you're going to have people in this audience who are at maybe smaller fintechs, maybe bigger fintechs, and very sophisticated financial institutions. So maybe there's not a one-size-fits-all answer, but a little bit of thinking about how you make that move from sort of early research to a great product without any unnecessary injury to yourself.
Well, I think you've identified one of the great pitfalls with a lot of in the AI world is that typically the researchers are focused on a particular scientific aspect of AI and development of the technology, and they're not thinking about its implications for existing laws and regulations and how what they're working on whether or not it's going to run afoul. They're not necessarily designing with that in mind. And so they may come up with something, a new innovation that they're very excited about, and they see the potential for improving results for both the company and providing a better service for customers. And I think this is more of a risk in smaller companies, but also in larger ones too, is that they jump to move to the market before spending the time to say, okay, we've established this research has led to this new product, this new innovation related to AI. Now let's do our regulatory and legal analysis before we take the next step. Because if you move too fast to market without making sure that you're in compliance with existing statutes and laws, actually you can run into a real problem. And compared to kind of traditional banking products, where banks are very accustomed to developing, working with their regulators when they bring new products to customers, our fintech world, which is largely outside of the bank regulatory regime, doesn't have the same customs and norms around the development of new products. So I think that's one in particular that that needs to be really watched with all this new development. It's very exciting, but there are still risks there on the back end if companies don't make sure they spend the time to get the compliance side down as well.
Thanks, Andrew. Very much appreciate that. So I think this is something I'm very interested in hearing about from everyone here. And maybe we'll start with Ed, because Ed, you talked about this a little bit already. But what is the best way for folks to interface with your office? And I know, Ed, you talked about no action letters, you talked about sandbox and trial disclosure. But maybe break it down for us a little bit more. Maybe some practical things. Should they just call you on the phone? Should they send you an email? Should they get Mayor Brown to do that for them? What sort of makes sense? What's a great way for people to interface with you?
Yes, especially Mayor Brown. That's the best way. But it's a fine way, but it's not limited to Mayor Brown, of course. Anyway, yeah, I think we like, and I think this is true of all the innovation offices. I'm sure Beth will agree. We all just have very much an open door policy. We have our own inbox on innovation at cfpb.gov. So you can send us an email anytime. If you have my phone number, you can pick up the phone. It's not widely publicized, but so that's general. Then somewhat more formally, then we going way back to when we had something called Project Catalyst that was started at the Bureau earlier. We started a whole process of having office hours. Sometimes we'd go to the San Francisco office, sometimes the New York office, and basically companies would be free to sign up and come in and talk to us about their products and services. We've continued that now, but we're doing it more in the context of this entity called ACFIN, the American Consumer Financial Innovation Network, which we launched back in September 2019. And it's basically a network of state and federal regulators that are interested in promoting consumer beneficial innovation. glad to report that the OCC is now a member, and we actually had, we've been having starting a process of having joint office hours between the Bureau and another member or one or more members. So the first one we did was back at the end of July with the OCC, joint virtual office hours over 2 days. And we had, and I'm sure Beth can talk more about this as well, had a great response. We had way more applicants than we were able to accommodate. And so we're actually planning to do the next set of joint virtual office hours with the regulators from Arizona and Colorado that are also members of ACFIN in the coming month or so. And then in addition to that, yes, we have our 3 policies. And under those policies, we encourage potential applicants to come in and talk to us informally before they submit an application. So through all those ways, that's how anyone interested in interacting with us should not have much difficulty in making contact.
That's fantastic. It's very telling that you're oversubscribed, and it really does show that people feel they're really getting a lot of value there, which is great to see.
Yeah. Let me just maybe I just add a few statistics. So I think since the policies were issued in September, we've now granted 7 applications in various areas under at least the no action letter policy and the compliance assistant sandbox policy. And we have in our pipeline probably a dozen more that we're processing. So that's been working very well.
Oh, it's fantastic to hear. Let me ask Beth to maybe talk a little bit about the same thing, if you'd be so kind.
Sure. I think it's very similar to what we've seen or what Ed spoke about. One of the key things is, please, we'd like to see folks, and you don't have to be a bank, to reach out to the Office of Innovation. We spend a lot of time with companies of all sizes and in different points of their maturity, talking about these issues. It's outside of the examination process. So it's an opportunity to really get technical assistance from a regulator, and have an opportunity for everyone to learn about the companies and what they're developing, as well as to learn how the OCC is looking at it. We don't endorse any product, but we do spend a lot of time talking about the products, and we want to hear about that. We also have office hours, as Ed mentioned, and I think the joint office hours that we did in July with the CFPB, first time we've done that, was a great opportunity. It was very successful from our perspective, and I think at least from the companies that we spoke to in office hours, it's a great opportunity to see both from a safety and soundness prudential side as well as a consumer compliance side, and putting that all together in one room. And we hope to do things like that similarly in the future. One other thing that I would point out, and I want to just echo something that Andrew was saying, is that fintechs, and we also are seeing banks do this, are moving to this agile development approach where you focus on a minimal viable product. And there's a lot of advantages to doing that, and a lot of opportunities for reducing risk. But if you're not taking into account, especially in the financial services area, the compliance risk, the regulatory concepts that need to be included into a product, you're not going to be successful with that approach any more than you'd be successful with the waterfall approach. So the opportunity to come in and speak to offices of innovation, and there are all the agencies have some form of an office of innovation now. Take advantage of that. And particularly when you're developing your products, whether you're using the agile approach or not. And one other thing that I would leave with is for the banks that are in the audience. You're welcome to reach out to the Office of Innovation at the OCC, but you can also reach out to your portfolio manager or your examiner in charge, and they will reach out to us. And we're happy to set up a conversation that way as well.
Yeah, I mean, I think that's just such tremendous advice. I mean, the opportunity to get free advice from a regulator who is so important in the space and so important to your success, and who wants to see you succeed, and who can give you advice to help you succeed, is just it's invaluable. It really should be taken advantage of. Andrew, I want to throw it to you, and I want to actually ask it to you ever so slightly different than the others, because I think some of our audience may be more familiar with the CFPB, may be more familiar with the OCC. Talk to us about not only the best way to interface with either NEC or the administration more broadly, but also when it makes sense to do so, and why. You know, where do they come in? How can they help this audience with what they want to achieve?
Sure. It's actually pretty simple. It's very much like the regulators. Simply, reach out, contact them. Their telephone numbers and email addresses, I think, are pretty readily accessible. And when I was at the NEC, we had very much an open door policy that if anyone had a legitimate issue that they wanted to come and discuss with us, we wanted to sit down with them and would have at least one staff member sit down and hear their issue, and then if there was appropriate, we'd raise and start thinking about how we could help on the issue. Now in this area, where the NEC really comes in is the kind of broad overview of government policy. On AI, we work very closely with several other White House components, OSTP, Office of American Innovation, also have really big leading roles. My former colleague, Michael Kratsios, did a lot of great work and pioneering work in driving this initiative, and was behind the EO. So it's a very collaborative environment over there on these issues. The other area, the reason that you want to raise some of these issues from White House perspective, is that they do have such broad application, and that while we're pretty focused on the financial regulatory world, as I mentioned, there's a lot of spillover impacts. The R&D is not something that typically the financial regulators handle, but it also can be it's a critical aspect of the overall development of the field of AI. Looking at how other agencies also are moving forward on providing regulatory guidance and regulatory relief to spur the development of AI also can be useful when you're going and actually going before Beth or Ed to say, we're working on a particular issue. Here's a similar issue that this other agency worked on, and this is how they handled them, and to bring it to their attention too. Because it also, one of the nice things about our fractured regulatory system is it does allow for some experimentation and other agencies to go off and try something, and then if it works, other agencies to adopt. The big picture on all these on these engagements, and why it's so important, the kind of the work that Beth and Ed are doing, is that AI is still a relatively new field, and the American public is still getting used to this technology. I think they understand the promise of it, but there are a lot of pitfalls and potential perils. Privacy issues, fair lending issues, just to name a few. And it's really important that as this technology develops, that it's done in accordance with the law and in a manner where the American public becomes comfortable with it. And that comfort will help spread adoption and facilitate its benefits being spread throughout the economy. The last thing we want to have, though, is developments of AI suddenly not to have the trust of the general public, and that could set back a lot of the wonderful developments that we're seeing.
Thanks, Andrew. And I think that that's really a perfect segue to the next thing I wanted to talk about, which is, as financial services companies are contemplating a larger role for AI, sometimes a consequence of that is we may see less reliance on humans. And I'll give one example. There undoubtedly are many others. But one of the ones that I've seen is in investigating red flags or, other signs of fraud, of BSA AML violation, BSA AML issues, basically money laundering, terrorist financing, this type of thing. And some of that first line review that historically has been done by humans, increasingly a thought of maybe that is better done by artificial intelligence. And Beth, maybe I'll start with you. what is the OCC looking for to be comfortable? And maybe this is universal, maybe it's different for different use cases like BSA/ML. But what is the OCC wanting to see to be comfortable before a financial services company takes a traditionally human function and makes that something that is going to be done more with a smart machine?
I think it starts with what we expect in whenever you're implementing a new process, a new product, or a new service. And that's really looking at planning for that and making sure that the use is done in a responsible way, commensurate with the risk exposure of the associated function or activity. And that is something that we spend a lot of time talking to institutions about, because I think sometimes with innovations, particularly with AI for some reason, there's a lot of thought about you can put it in and forget those standard blocking and tackling pieces. And that's the case. I mean, institutions have been moving to a more automated way. It can provide a lot of operational efficiencies, and we've seen institutions do that for a long time. It's not just with respect to artificial intelligence, but doing it in a very planned and responsible way is a key. The other thing is you can't really take the human out of it. AI is a tool. And machine learning is a tool. It's a tool that is designed to help the institution be more effective in the way that it manages its risk and its responsibilities. But you still need humans to oversee it. You still need humans to understand what the machine is doing to make sure that the outcomes that the institution expects are, in fact, the outcomes that are occurring. So we always talk about the fact that you cannot just put something in and say, okay, the machine made me do it and be done with it. It's really important that there be a balance between utilizing the benefits of the machine with that overall oversight that humans do very effectively.
Yeah, Alex, Alex, I'll jump in there just because I want to follow up. I think Beth made a really key point here that another point to remember is the importance of workforce training and making sure that we have a workforce that is capable, again, of handling the issues, first in the development of AI and then the deployment. And those skill sets are pretty rare right now. They're certainly growing. And now, as I mentioned, the president is focused on having federal agencies devote more resources to building the skills in our workforce to be able to continue to develop AI. But I think on a company-wide basis, Beth's point about AI still being human, I don't think it can be emphasized enough. It still requires human judgment. Simply just kind of flipping the switch and thinking that the issue is over is the way you'll run into trouble. And where Ed and Beth can be helpful up front through the kind of human interaction and human judgment about how to deploy. On the back end, as we've mentioned earlier, if you don't have that trained workforce to oversee and implement your AI, you're going to run into the regulatory side, regulatory enforcement side, which won't be as welcoming. So, I think anyone who leads a group deploying AI knows the workforce is the key to successful AI use.
And I think, Beth and Andrew, I think that's such an excellent point. Certainly in the example I was talking about with using artificial intelligence for some AML BSA screening, there was both the escalation for more sophisticated cases to humans and a very important, from what I've seen, human management component in setting up that AI, not just setting it up, but keeping it on track, and particularly in the area of attacks that are specifically designed to aim at AI that is screening. I've seen people describe attacks that are analogous to the bad guys send through. The analogy would be sending through 1,000 people who look like terrorists with machine guns through the X-ray screening, so that the AI learns to look for that and overlooks the drug dealer that they're really trying to sneak through. So you do have to have human beings in the loop, and on top of this, the machines really aren't in any position to replace human beings. Ed, I wanted to turn to you on this question as well, And if you have anything to add from the CFPB perspective of dealing with this complicated issue where we're seeing maybe more with machines, maybe less with humans, and striking the right balance and being comfortable when we get there.
With what both Beth and Andrew said, I think in just a very high level, and this harkens back to some other earlier points. You have to make sure that whatever you're doing is compliant with the law. And in particular, I think we often will stress, like, you have to have, a well-designed and robust compliance management system. And part of having such a system is that it gives extra attention to things that are more likely to be higher risk. And so introducing things such as AI, ML into your mix of products and tools, it's inevitably going to create, more risk. And so you have to give extra attention to it, not just, far from treating it, just not treating it at all, or just treating it like everything else. You probably actually have to give extra attention to it because of the novelty of it.
Thanks, Ed. Very helpful. Appreciate it. So I want to turn back to something that maybe we've touched on earlier, but maybe there's a little bit more to it, and maybe it's worth a little bit of a deeper dive, which is, what do we see as the primary areas of legal and regulatory risk for AI and financial services? Is it the thing that I've historically paid the most attention to and thought is the easiest area to have something go awry, which would be fair lending, fair decisioning, and maybe adverse action notices? Or are there other areas that people should really think, these are maybe the coming or overlooked hot spots? And with that, and any thoughts on things to be alert for in terms of making sure that compliance is the way that you might hope it would be? Beth, why don't I start with you on this one?
Sure. I guess I'll start broadly in the sense that I think that it's very critical, again, not just AI specific, but whenever you're utilizing a new technology, it's really key to understand that technology and determine whether or not it's fit for use. So a lot of folks think that AI is the greatest thing since sliced bread, and it can be applied in all cases. And that's not necessarily the case. AI can be extremely helpful in some cases, but whatever you're doing, fit for use, because that can trigger, if it's not, it can trigger not only concerns that you highlighted, Alex, from a consumer compliance perspective, but it can trigger safety and soundness issues. It can trigger reputation risk. It can create challenges from a strategic risk perspective. You could have governance challenges within your institution. So it really needs to start with that whole idea of whether or not it's fit for use. I think some of the other challenges, and both Andrew and Ed have highlighted some of this already, are don't underestimate some of the issues around privacy and data governance. We always used to talk about the fact that data is key, data is the new oil, some of these different phrases. But these particular models or technologies are so data sensitive. Data is so important to that. And they don't have to be, but they can be also very complex models where the very just missing a little piece of data here or there could have a drastic impact on a change in what that outcome is. So thinking about those data perspectives and the privacy around that data, how you're going to maintain it, what's the governance around it, are some of the key things I think any institution or any fintech that is looking at this needs to consider on the front end before they develop or implement AI.
Thanks. That's very helpful. Appreciate that. Speaking to a muted phone there briefly. Ed, do you want to add anything to those thoughts?
Yeah, I think as my remarks earlier made clear, I think certainly our central focus here is on credit, on the use of AI, ML, and credit underwriting, and monitoring for discrimination, and ensuring that adverse action notices are as accurate and helpful as they can be. And so to that end, we issued the no action letter to Upstart, and that's really been a great opportunity for us because of providing the testing results. We really sort of feel like we can look at the data under the hood and make sure and get a better sense of how these complex models work and what are the potential pitfalls for using so many variables. I think that's been very helpful. And as I said earlier, uncertainty, a lot of uncertainty remains in this area, so we're always looking for new applications that we could issue in response, issue a no action letter or an approval or a trial disclosure waiver to get more insight into these areas. So I maybe just mention one other area where I think the Bureau I could see the Bureau having interest, and that is, in addition to ECOA and Reg B, we have a jurisdiction authority for a broad range of consumer financial protection laws. Now under Dodd-Frank, and we have our own UDAP authority, of course. And so really anything where, just to give one example, like the use of chatbots and so forth in the area of potentially the company dealing with consumers using robotics, that can raise potential compliance concerns in a broad array of things like debt collection, for example. You wanted to start to use bots to communicate with consumers about their debt. That could raise issues about deception and just whether you complied with the disclosure requirements of all these different laws and regulations. So I think as others have mentioned, there's a growing pressure on industry just for all sorts of reasons to move in that direction. I don't think it's been done that heavily yet, but I can see that industry is moving in that direction. And I think that's just going to be a continuing effort on both sides to make sure that the use of non-human communicators, as it were, is still compliant with existing law.
Very interesting about the chatbots, and not something that I think myself focused on maybe as much as I should have. I'd like to follow up on something Beth raised, and maybe actually I'll turn it to Andrew first, but I'd be interested in hearing everyone's views. And I thought, Beth made what's a crucial point in this space, which is, big data is the fuel that AI runs on. People talk about big data and data in this country as being a huge resource, as being our most valuable resource. All sorts of headline-grabbing things. There's a lot to think about there, but I thought maybe, Andrew, it would be interesting if you have a word or two about the administration perspective on this, and particularly, you have an economic interest, right? If it is a great resource in utilizing it through AI and through other mechanisms. On the other hand, you have American privacy to protect, both domestically against, proper but commercial uses that consumers might not want. Across borders against people who might try to exploit data for bad purposes. That's a lot to balance. So give us some insights from an administration perspective, if you can.
Yeah, you've raised a really important point because data is certainly becoming a new fault line in American foreign policy and around the globe. And you've seen other countries take very strong actions about the protection of data within their jurisdictions. You've seen the EU do it. You've seen India do it. You've seen China do it. And so countries are increasingly realizing the resource that the data that their citizens produce is a strategic and national resource that needs to be protected for the value that it can provide. In addition to protecting the privacy issues involved. So you've already seen this administration recently with its actions on TikTok and WeChat raise those concerns, take steps to make sure that Americans' privacy and data is protected and not used for nefarious purposes. I think this is just the beginning of a new approach to foreign policy. Now that we've countries around the world know how important this data is, you're going to see a lot more regulation and a lot more actions taken to prevent certain data from crossing borders. Now that also presents an issue for companies, because in most cases, right, more data is going to be better and help produce better outcomes. So there's going to be this tension between privacy, national security, and economic benefits that companies are going to have to closely navigate.
Yeah, no, I think that's very well put. Ed, let's chat with you a little bit. You know, from a CFPB perspective, as companies, you know, work to gather and mine and use data in a productive way, without tripping over privacy, without doing anything inappropriate, what guidance, what thoughts does the CFPB have on best practices and you know, moving forward?
Sure. Yeah, I think maybe it would be helpful to bring in here the fact that under Dodd-Frank Act 1033, to promulgate rules in this whole area of consumers giving access to their account data and so forth to be used by companies providing, you know, new types of services to them, such as, you know, your nerd wallets and credit karmas and so forth. So that, I think, is something that we're very focused on. I think we announced earlier, after monitoring this market, this area for a number of years, I think going back about 3 years or so, we put out some principles that all participants in this market should keep in mind as they're developing these products and services. That we just announced recently that we're coming out with an ANPR, an advance notice proposed rulemaking, for potential 1033 rulemaking. So, and part of that is very much issues about the privacy of the data, consumer control over once they grant access to a company to use their data, you know, what limits are there on what the company's use of that data, how easy is it for the consumer to turn off access to that data. So that's a whole separate work stream within the Bureau right now that touches on some of these issues, I think. Not necessarily, it doesn't necessarily involve use of AI/ML, but it certainly is very much focused on the advent of big data.
Thank you, Ed. Appreciate that. And Beth, you were the one who I think, you know, wisely brought this topic to the attention of the group. And I just want to make sure that we close off with any further thoughts from you on these complicated issues of the best way. You spoke some about this already, but on the complicated issues of the best way to both gather and make use of this data.
Yeah, I think both Andrew and Ed have raised a lot of the really excellent points in this area. I would just highlight a couple. First is around data security. And that becomes even more critical than it was before, as more data points are gathered on a particular individual. Then criminals and cyber attackers are even more interested in getting that information and accessing that information, because it's becoming even increasingly more valuable. So it becomes very critical in securing that data. The OCC has issued an FAQ recently with respect to our third-party risk management guidance that goes into some expectations around the security of the data. And I think that's a really important point. The other thing is to think about, again, going back to that fit to purpose point that I talked about in the past, you also have to think about the data and is the data that fit for the purpose that you're using. Probably a lesser risk or concern than certainly the risk and the concerns that have been raised so far, but thinking about potentially the reputational risk that there is in the type of data that they're using. Some of the data usages may not be things that consumers and other customers are comfortable with. Like, we remember when the first talk of alternative data came out, it was about like Facebook likes. And the more you something that supposedly created a view of how risky you were. Apparently, I'm risky because I use exclamation points in some of my emails, and those types of things were customers or consumers were comfortable with. And they didn't think that that actually was potentially a use that would be acceptable. So it's thinking about it from that perspective, again, not to underplay the critical points that we've been talking about, but thinking about it from that perspective is also important.
Yeah, the point of consumer comfort and confidence, I think, is definitely something we all want to keep sight of, because at the end of the day, we all have, to some extent, consumers, to a greater or larger extent, we all have consumers to answer for and to take responsibility for in what we do. And I think the example you give with regard to the exclamation points, it's both illustrative when, you know, because of who you are, that perhaps it just, at least anecdotally, can't possibly be a good assessment of risk. But also, you know, it's an interesting thing, right? When we look at something like adverse action notices, right? Part of the function there was to enable consumers to say, oh, I didn't get this loan because my debt to income ratio isn't good. I should pay down my debt or increase my income. They should fix it. And when you tell someone they didn't get the loan because they had exclamation points, what does it tell them to do other than to perhaps game the system? And maybe it's not even gaming the system, but just make a correction that doesn't really go to something fundamental that we could have faith in. So I think, as I hear that what you say, just it makes a tremendous amount of sense to me. Switching gears a little bit, I want to talk, if I may, about the black box nature of AI, because I think that's, you know, we've accepted this as one of sort of the things about AI. There is increasingly technology, explainable AI or XAI, that aims to penetrate the black box, but it lags behind the lack of explanation. And Ed, maybe we start off with you with this one. Are there circumstances in which the black box nature of AI makes it inappropriate to use for certain use cases, poses a problem that is insurmountable? Is it hard to say? Is explainable AI recommended, needed? How do we get our arms around this black box problem and what we ought to be doing about it?
Sure. I mean, it's obviously been a very hot topic in recent years. I mean, I think my view has come to be that it's really not a black and white issue, as it were, because you know, going back to what I said towards the outset, first of all, when it comes to adverse notices, there's a lot of flexibility in the current regulations already. So you can accommodate it to some extent there. In addition, because of this has been such a hot topic, there's a slew of companies out there who've been developing ways to come up with better explanations for companies using AI ML and are offering their products to lenders. And I think as we monitor that, we've seen that that's continuing, and the explanations are getting better. There's ways to deal with it. So I think overall, I'm optimistic that sort of seemingly insurmountable black box problem will be solved to a large extent, and not that it's completely solved yet, but I think we're looking for ways to improve on that. Again, that's one reason we're having the tech spread next week. We're trying to marshal all of these forces that are working on this problem to come up with innovative ideas for dealing with that problem. And so we're particularly interested, I think, and we mentioned this in our blog post from July, what in new and better ways of determining the principal reasons for the adverse action, new and better ways for making the explanations more accurate, and also, to pick up on the point you made, ways of conveying this information that consumers are going to be able to understand and hopefully take into account in changing their behavior in some way. I do think the issue of using variables that are not related to behavior is a problematic issue, and not to say that it shouldn't be done at all, but I think that that making that connection between using a variable that is predictive, but is also not something that consumers can do much about, is a really tough nut to crack. And I think we're very much interested in anything that could be done along those lines.
Ed, what about variables that are predictive and possibly even something someone can do something about, but just totally counterintuitive?
Yeah, I think that's
some of those, right?
Oh yes, and I think that's a somewhat less concerning problem, but it remains a problem, I think, at a minimum for the oversight kind of concern that Beth raised. I mean, if you have variables that do not have this intuitive connection to creditworthiness, that just poses a problem of that always is going to have a question mark over it, like, is there some form of discrimination going on here, right? So that's something we're also very much focused on. And whether anything ultimately can do to change people's attitudes and perceptions of that issue of whether there has to be an intuitive connection between the variable and creditworthiness, maybe that's just something that society in general will evolve to some degree over time. But it's another tough problem. So thanks for raising that.
Andrew, from an administration perspective, the black box problem, is it something we solve with greater research, greater consumer confidence? Is it something, how do we think about this?
Yeah, so far a lot of our conversation has been focused on the implications for consumers, and that's appropriate. But the growing issue will also be the relationship between a firm using AI and either its third-party vendors that's supplying the AI technology and/or its regulators. And as AI is used more for risk management techniques, you can't have a black box for your regulator. Your regulator is going to have to know, especially if it's a safety impinges on safety and soundness issues, exactly how that technology works, the factors that go in. And I think again, this comes back with the workforce issue, is making sure that we have sufficient numbers of employees who adequately know how that technology works and critically can explain it and get the regulators comfortable with it. That conversation could mean the difference between regulators allowing you to use that technology and securing the benefits and holding off. So I think that's another important area to really think about it. Somebody once said, there are no secrets in Washington. Well, there are no secrets when it comes to technology and financial regulation. We all know the importance of sound risk management, and it plays in addressing systemic risks and safety and soundness. And so you just have to begin with the presumption that if it's a black box and people don't understand it, that's a problem, and you have to figure out how to make sure it's explainable.
Beth, I want to give you the last word on this topic before I turn to give you the first word on the topic that comes from it. So if you have anything further to add, we'd love to hear it.
Yeah, I would just add something that Andrew said. I think it's critical that that the boxes be understood. But I also want to point out that there are black boxes out there today, but we have accepted that, and they're now part of the status quo, and people are comfortable with that. What I think we have to really look at is when we're talking about, we really need to understand these models. Now, there's balance. It depends on the use of that model. Transparency, explainability, complexity are all things that need to be balanced and understood. And when we talk about a model, particularly, I have a lot of conversations with third parties that have these models. We're not talking about looking at your secret sauce or taking the secret sauce that makes your product, a profitable product. What we're really talking about is getting enough information about that product to make sure that for its use, it's fit for purpose. We understand, and more importantly, the institution that is using that product understands what the risks are that they're able to understand the outcomes, and that those outcomes are the ones that they've expected, and that there's an opportunity to validate that model in a way so that that model can continue to remain effective. That can be done today, and it can be done in the future with so-called black boxes. There's just ways that we have to find ways to crack the black box, if you will, at AI, because it's just a little different of a black box.
Thanks, Beth. And so let me turn to what I think is somewhat of a logical follow-up to this, which is model validation in the AI world, right? And we have SR 11-7, which my dyslexic brain wants to always rearrange into the order of the convenience store. Is this still the right thing? Is it like the Constitution is sufficiently broad and sufficiently flexible that in the AI world it still works? Or is it something where maybe it's time to think about revamping it a bit? Thoughts?
So there are a lot of good principles in the model risk management guidance that are key now and can be very applicable to AI. The conversations that are contained in that guidance around governance, the expectations around validation, all of those are critical and important components that the agencies and OCC believes are very applicable to AI. Now, there may be some situations where we need to tweak the guidance or address particular issues that AI raises. One question that's come up quite a bit is there's emphasis in the guidance around back testing for validation, for example. And back testing may not be the best technique for a model that is constantly learning and constantly adapting itself given the data that it continues to receive. But there are other outcome testing methods that can be used in that particular case. And so some of it may be a matter of expanding the guidance or doing it in a form of FAQs. But the key cornerstones of that guidance are still applicable from our perspective.
Thank you. Very helpful. Ed, anything you want to add on this? Maybe a little bit more deeper in the weeds of the questions we've gotten into here today of the supervisory letter SR 11-7 and its applicability in this context.
Yeah, sure. I would just point out that this particular supervisory letter is not something that the Bureau has officially signed on to. I think primarily not for any reasons about its content, but more about jurisdiction. The Bureau having a somewhat different jurisdiction than the prudential regulators. And I think we're generally supportive of what's in there. I think we're supportive of everything that Beth just said. I think what we're looking at is sort of how to maybe meld what's in there with our own concerns, our own mandates. For just give one example, as well known, one of the aspects of the disparate impact burden shifting test is whether the item in question meets a legitimate business need that cannot reasonably be achieved as well by means that are less disparate in their impact. So I think we're definitely trying to think about how would that play into assessing the risk of a given model. So it's an ongoing effort on our part.
Thanks, Ed. Okay, so look, I'd like to ask everyone one concluding question to wrap us up here today, if I may. And that is, we have a great audience here today. A lot of people have registered in advance, some very top people from some very top companies around the country. And taking that opportunity to speak to this audience, what is your ask for industry? What would be most helpful to your office? What do you think would be most helpful to the joint goals we all share of success in this area, of economic benefit in this area, and of protection of consumers?
Yeah, I could go first if you'd like.
Please, please.
Yeah, I think I would say from the point of view of the CFPB, I think, as I've said, I mean, we're all about facilitating consumer beneficial innovation. That's one of the Bureau's objectives built into the Dodd-Frank Act, and that's the foundation for our office. So, and one of the ways we do that is by trying in various ways to reduce regulatory uncertainty, and through our 3 innovation policies. The Bureau's also announced more recently an advisory opinion pilot and a proposed advisory opinion program as another aspect to that. So I think, simply put, my ask to all of you watching is, like, if you are aware of any areas of regulatory uncertainty out there that are impeding the development in one way or another of potentially beneficial products and services, please come to us and alert us to that. And we could potentially, through our 3 innovation policies and our new advisory opinion program, try to address that and clear the road to get these products and services out there. So I think that's, very simply put, is what we're asking.
Beth, over to you.
I think it's very similar to Ed in terms of, my ask would be, let there be a willingness of the entire industry to come and reach out to the Office of Innovation where there is regulatory uncertainty or where there are just some questions. We've had a lot of situations where there's just a perception that the regulators will say no, when in fact that's not the case. And so having a to come and speak to the OCC about the challenges that they're facing or what they perceive the challenges to be, so that we can clarify them. And for those out there, those fintechs, if they're willing to also come and speak to the OCC, I know we don't regulate you directly, and actually that's probably a good advantage for you. Come and talk to us about some of your models and how they really work and how they're intended. The OCC is hoping to build a further evaluation function within the Office of Innovation in the near future, so that we can do more deeper dives and into these issues. And so for companies that are building these products and really working to come and meet with us and let us look under the hood, so to will be very helpful to us, but also we hope to the industry.
That's fantastic. Andrew, any thoughts to close us out with on this question?
I just expand on both Beth and Ed's comments on the importance of kind of engaging not only with the regulator, but also with the larger federal government, and one, that there are a lot of resources available here. Again, I mentioned R&D resources, training resources, the availability of data that the federal government has collected to help improve AI models. Across the federal government, there are a lot of ways that companies can engage, and it's important to take that holistic approach to utilize all those benefits.
Yeah, and Alex, could I just add one codicil to what I said earlier? And that is that under our trial disclosure policy, actually, we have the authority under Dodd-Frank Act 1032E to actually exempt companies from current disclosure requirements. So that is the one instance where it's not just a matter of uncertainty, where what you think, even though there's uncertainty, you think what you're doing is compliant. If you want to test a new kind of way of disclosing something and it's clearly non-compliant, you can come to us and we can give you an exemption for a limited period of time so that you could actually test out your new idea in market as opposed to a laboratory and see if it actually is better and provide us with testing result data about that. We said in the policy that if in cases where that is done and we get data showing that the new disclosure is more beneficial, increases consumer understanding, what have you, we would have a commitment to building that into revising the regulations more broadly. So that's just one area where we actually have a different kind of authority that even permits exemptions. I just want to make sure that's clear.
Thanks for adding that. That is a great concluding thought on our theme of really open doors and cooperation with industry, which is something I think came across beautifully today. This concludes the webinar. I really want to thank our panelists for really tremendous, fantastic insights and for taking time to speak with us here today. I also want to thank all the audience members who took the time to watch, and I hope that everyone found it useful and helpful as I did. Thanks, everyone, and have a great day.
All right. Thanks, Alex. You were a great moderator.
Thank you.
Thank you.